what's ahead. A Fed power player, St. Louis Fed President James Bullard, he is here. He's known to speak his mind about the central bank's inflation fight. How big should the Fed go in September? Stay tuned to find out. And if you're looking to protect your portfolio against inflation, our market pro is buying up some energy names. He will tell you which ones later this hour. Hi.
All right, Seema, thank you very much, and welcome, everybody. Materials, communication services, and financials leading the market higher at this hour. There you see the Dow Industrials up 114, the S&P 500 higher by about 0.75%, and the NASDAQ, if I move my hands out of the way, you will see that it is up 1.09%. Two cloud stocks moving in different directions. Snowflake surging 20% this afternoon on strong quarterlies, while Salesforce moving the other way, sliding, disappointing forecast for fiscal 23. Shares of Peloton tumbling after the company reported its sixth straight quarterly loss. The stock did surge 20% yesterday on a partnership with Amazon. Seema.
The biggest event of the week for investors. Happening now, Tyler. That's
right. At the Fed Jackson Hole Symposium, the Fed Chair Jerome Powell is speaking there tomorrow morning. Investors looking for clues on the size of the coming rate hikes. Our next guest is known for speaking his mind when it comes to how aggressive the Fed should be in fighting inflation. St. Louis Fed President James Bullard is with Steve Leisman in Wyoming for a First on CNBC interview. Hi, Steve.
Hey, Tyler, thank you very much. Yeah, our Jackson Hole coverage continues here with St. Louis Fed President Jim Bullard. Jim, thanks for joining us.
Happy to be here.
Tyler gives you a curtain raiser there, a man who speaks his mind, not afraid to talk about where things are going. What's your take on, we talked a couple weeks ago, you talked about a 4.4% peak funds rate. Are you still in line with that idea?
I think I said 375 to 4
okay.
is my target for this year, for the end of this year. And I like the front loading. I like the idea that you get the rate increases in earlier rather than later. We've got inflation right now. We've got a strong labor market right now. It seems like a good time to get to the right neighborhood for the funds rate.
We had a good debate in the noon hour about the idea of 50 or 75 and how much it matters. Why does it matter to go faster? What's the upside of that?
Yeah, I think the front-loading idea is that first of all, you show you're serious about inflation fighting, and you want to get up to the level that will put downward pressure on inflation. And we're at 233 right now. You know, that's not high enough to be serious about putting downward pressure on inflation. Market has helped us a lot. There's been a lot of pre-pricing during the spring and the summer here. But we have to get our policy rate to where it needs to be to put downward pressure on inflation. And I think you got to have a 3 handle.
What happens after 375 to 4 at the end of this year?
Yeah, I haven't talked much about next year, and I think...
Feel free.
Yeah, well, this is such a volatile environment that you're not quite sure what's next, and so I think I'd want to be careful about promising anything one way or another about what would happen next year. But, you know, a baseline would be that probably inflation will be more persistent than what many on Wall Street expect, and that's going to be higher for longer, and I think that's a risk that's underpriced in markets today.
Yeah, so do you worry about that when you look at the outlying futures contracts and say they're not embracing the rate hikes that I think, or the kind of financial conditions that I think need to be there?
They're showing outstanding confidence in the Federal Reserve, which I appreciate, and I really hope that they're right. If we act early and aggressively, that we will bring inflation under control relatively quickly. But the risk is that the other side of that isn't being priced enough, and you know, the reality is we may have to be higher for longer.
Talk to me about how you react. And I understand you try not to react to the day-to-day changes, but in general, when you see the stock market rising, you see bond yields falling, does it make you feel like you have other work to do?
You know, I try to stay kind of away from equity pricing because there's so many things going on in equity markets,
sure.
And a few stocks can drive the market on a given day. And usually those are developments at those particular firms. And you've got the heavy Silicon Valley component, and who knows how to value those companies. So I don't want to take too much signal from equities when I'm trying to make monetary policy. Try to look at other aspects of asset pricing, spreads, volatility, levels of rates.
But right now,
real rates.
Bond markets yields are higher. Does that give you more comfort that your message is getting out of what it is you want the market to embrace about financial conditions and where they're going?
I would say that that's a little better pricing of the risk that we'll have to do more at the Fed to keep inflation under control.
You talked earlier about this idea of inflation being more permanent. The topic of the conference here is constraints on the economy. There's some discussion and talk about the idea that maybe some of the factors that have led to high inflation now may stick around. Is there a world that's coming in, or an economy coming to the U.S. of higher permanent inflation?
I don't see any reason why we have to have that. I mean, you need to understand the economy in order to make monetary policy. And I would say if there are structural issues or things that are changing, that's very relevant for making monetary policy. But really, in the end, we have an inflation target because it's up to the central bank to hit the inflation target. And, you take all those factors on board, you print the right amount of money for that situation, you should be able to hit the inflation target even if there are these long-run structural factors. I mean, it's important to understand those factors, but that doesn't stop us from hitting the 2% inflation target.
When you talk about hitting the target, does it matter to you if there's a recession in terms of the making of your policy? Obviously, you would care if there was a recession, but does it matter in the making of your monetary policy if there's a recession or not?
Well, of course, we have two sides to the mandate, and we have a labor market side. And if the labor market was very disturbed, that would enter into our calculations. So that's important. I don't think recessions are all that predictable. There are models out there that try to do something, but they don't do that great of a job. And when you think about the big recessions that we've had recently, the pandemic or the global financial crisis, those were essentially unpredictable events. I wouldn't go overboard on that, but they're hard to predict events. So yes, of course, we're taking recession risk, and there is recession risk out there in the future, but I don't think we know that there's going to be a recession one way or the other.
So walk me through your base case for next year, or even the second half. We had those two negative quarters. Does negative growth continue into the second half? And what happens in 2023? How much does inflation come down?
Okay, so what I'm thinking right now, if you look at the GDI number, so
right.
GDP...
Let me interject. Gross domestic income, which is how much we take in versus the value of what we put out, they should be equal, but they're not.
So these two, GDP and GDI, are supposed to be the same, but they're not. And GDI, according to the estimate that just came out
this morning,
is actually positive for the second quarter. The growth rate was positive. I think the GDI in this particular instance for the first half of 2022 is giving you the better metric on what was going on. It was a slower economy, but you had a heck of a lot of jobs added. Now it looks like 3.2 million jobs added in the first half of this year.
Well, they just added another 500,000.
They just added another 500,000. So it's really a lively job market, and that's consistent with what everybody says when you talk to businesses. It's hard to hire workers. It's hard to fill jobs.
Jimmy, talk to me about the making of policy. Chair Powell has acknowledged there were mistakes that were made. Is the Fed addressing those, and how are those addressing those? And when you look back on the decisions that were made, for example, to continue to buy assets when it seemed pretty clear there was an inflation problem, how do you fix that, or do you need to fix it?
Well, I think we did fix it in a way.
If you by changing policy. I mean the process by which you arrived at that, where everybody agreed we should keep buying assets.
Yeah, I just think when the pandemic came along, just to defend what we did a little bit, the pandemic came along. Of course, it was a gigantic shock, and we were all in to try to protect the U.S. economy from this really big shock. And we set out a path that was, kind of overboard, you might say, both in fiscal policy and in monetary policy. And that was by design. We didn't know how bad the pandemic would be. We didn't know what kind of damage it would do to the U.S. economy. As it turned out, the economy was more resilient than we thought, and some of that was kind of overdone, and we got some inflation out of it. I think that will be the way history looks at this. But now we have to switch back and say, okay, we got to get the fiscal situation has to settle down, and the monetary authority has to bring inflation back to 2%. I think we're doing, both of those things are going in the right direction.
Last question, Jim, but the median forecast of the Federal Reserve does not see inflation getting back to 2% over, say, the horizon of through 2024. Does that mean you're not been tough enough? You're not going to do enough in order to get back to your target? Why is it okay to miss your target for essentially 2.5 more years?
Yeah, I mean, with an 8 handle on CPI, I think we'd be happy now to get going in the right direction. There will be a debate at some point about how long do you want to linger above 2%, and what do you have to do to get it down and actually hit the target. And I think that's an important debate, but that's out there in the future.
Now it's getting it within the range.
Well, it's getting it moving in the right direction.
Right.
Let's get it toward 2%.
Jim, thanks very much for your time.
All right.
Jim Bullard, St. Louis Fed President from Jackson Hole. I believe we have Raphael Bostic coming up tomorrow, and of course, full coverage of Fed Chair Jay Powell's speech from the mountains, gentlemen and ladies.
Steve, thank you. James Bullard and Steve Leisman for us. And a lot there to digest, Tyler.
Yeah, a lot of macro
Higher for longer
information. Yeah.
Is what James says. But as we try to fixate on 2%, getting to that level, but also trying to quantify the trajectory of the move in consumer prices. We saw the big move in July. Does that signal that inflation has peaked? But as Esther George says this morning, she wants to see 3 months of consecutive data to say that inflation has peaked.
I think in the end there, you heard him say what is more important than hitting a target is moving in the right direction and consistently doing that, which is kind of what Esther George is looking for too, is moving in the right direction, bringing the numbers down, coming towards that target, and then we'll talk later about how we actually get to the target.
Dow up about 30 points, S&P 500 as well. Coming up, reaction and analysis to St. Louis Fed President James Bullard, plus a tech hub in the heartland. The governor of Oklahoma discussing his push to compete with Silicon Valley and make his state the center of transportation innovation. And later, Ron Barron says he's investing in Figs, Hyatt, and Red Rock resorts. Should you follow his lead? We'll trade those names in today's 3-stock lunch. Before the break, some of the names hitting 52-week highs in today's session. Take a look. C.H. Robinson, CF Industries, and On Semi. Power Lunch. We'll be right back.